Hello, and welcome to today's webinar on pension funds and the low carbon transition. A huge thank you to everyone whose efforts have made today possible, including the considerable support of the Peter Wall Institute. I'd like to open by acknowledging that the University of British Columbia, our virtual host today, is located on the unceded territory of the Musqueam people. And my name is Javeria Veldkamp. I'm director with the Canada Climate Law Initiative. We're living at a time now where our society is learning to cope with the first impacts of climate change, while simultaneously trying to prevent the worst. We have the technologies, we're transforming financial systems, and the regulatory and policy landscape is changing almost daily. The Canada Climate Law Initiative helps directors and trustees in Canada stay informed about how their obligations are changing in this fast-moving environment. I'm delighted to chair today's session about the role of public pension funds in the low carbon transition. We have a very special keynote this afternoon, wherever you are, from CCLI's own Professor Cynthia Williams, whose report on the Canada Pension Plan's fossil fuel investments came out just yesterday. After Professor Williams, we will hear from two distinguished pension advisors, Mr. Nick Silver and Mr. Simon Archer. And finally, we will have 15 to 20 minutes for questions. Now, I'd like to hand over to Professor Cynthia Williams, Osler Chair in Business Law at Osgoode Hall Law School and author of the report, Troubling Incrementalism. Is the Canadian Pension Fund doing enough?
Thank you. Thank you, Javeria, and thank you to everyone who's taking the time to listen to this webinar now and in the future, and to engage with this important issue. We've published this report to challenge CPP to use its considerable financial sophistication, the involuntary contributions of millions of Canadians and other workers in Canada, and its long-term investment horizon to challenge it to use it as a foundational partner in the transition to a low-carbon economy in Canada. We challenge it to stop establishing companies to support the oil sands in Canada and fracking in the United States. I'll talk about two such transactions, but rather to use its same skills and long-term investment horizon to explicitly and aggressively support the transition. In the last number of weeks, there have been excellent reports from the Task Force for a Resilient Recovery and from the Build Back Better Coalition, showing pragmatic solutions for Canada. And our goal with this report and with this webinar is to ask CPP to be a partner in that effort, those efforts. So the CPP, as probably everyone here knows, is one of the world's largest public pension funds, $434 billion of assets under management as of June 30th. The statutory mandate of CPP-Investments is 1, to manage the funds in the best interests, plural, of the CPP contributors and beneficiaries, and to maximize investment returns without undue risk of loss. The CEO of CPP recognizes that, quote, our investment mandate and professional governance insulate our decision-making from short-term distortions and gives us license to help shape the long-term future. We at CCLI agree with that, but we question what kind of long-term future right now CPP-Investments is shaping. What are some of the concerns? I think the next slide. Actually, before getting to concerns, let's be very clear about the context. CPP, I've been reading 6 years of annual reports, CPP, and of the strong view that CPP is a conscientious investor with a clear sense of responsibility to its 20 million contributors and beneficiaries. it is a professional, financially sophisticated management. Moreover, for the last few years, it has recognized climate change as a risk and has put in place systems to try to manage the risks of climate change and in some cases take advantage of opportunities. However, there is nothing that I've read which suggests CPP sees an important role for itself in funding the transition in Canada. And that's the role we are asking it to take on. Thank you. What are the concerns of the current situation? The first concern is that it's just not clear what CPP is actually doing with its investments in Canada. It is excellent to see that $63 billion of CPP funds are invested in Canada, but in the public reporting in its annual reports, at least half of that money is undescribed, even as to what asset class that half of the money, $33 billion, is invested in. And even in the investments where we can see the asset class, there are really no clear specifics about exactly what the money is doing within those asset class. So one of the things that we are asking for is for CPP's investments in Canada to be much more clearly described to the contributors, all of us. Thank you. Next slide. Second, to the extent that we can see investments, there do seem to be still a fairly hefty percentage or at least dollar amount in carbon intensive investments. Now, I've looked primarily at some of CPP's direct private investments, but an academic team last year, Rowe et al., looked at CPP's public equity holdings globally and in Canada and found 79 investments in the top 200 publicly traded global companies in oil, gas, and coal, meaning that to the extent those 200 companies have what will become stranded assets as the world transitions to a low carbon economy, those global public stock holdings are overvalued by at least almost 4 times. Looking only in Canada, CPP's list of its public equity holdings in Canada only lists about half of the $7 billion it states that it has in Canadian public equities. But looking at that list, we can see that 19.5% of the value of those identified holdings are in oil and gas stocks. That these oil and gas stocks have a depressing effect on the portfolio was admitted in CPP's latest annual report, where it is stated that, quote, in Canada, the decline in oil prices and its impact on the energy sector contributed to a further deterioration in Canadian equity performance, and they lost 12.2% in their Canadian public equities holdings. Now, it's important to note that CPP is not responsible for the fact that there are constrained choices among large publicly held companies in Canada. There is a disproportionate percentage of those companies that are in the extractive industries or are financial institutions supporting the extractive industries. But that's the problem that Canada needs to solve in its transition. And that's the problem that CPP does not seem to be solving. Thank you. Next slide, please. Now, why are all of these investments of concern? I would say Joanne Forbes has just linked this report in the chat functions. This is by Mercer, a large global asset manager and insurance company, a report from last summer entitled Investing in a Time of Climate Change. The data that you see here are the projections of Mercer working together with Cambridge Econometrica, which is an econometrics outfit out of Cambridge University that fed in regulatory changes and physical transition effects to projections in various asset classes and to various kinds of portfolio holdings. The data you see here are the most optimistic. They actually looked at 3 scenarios. This is the most optimistic scenario that they looked at. And what you can see is that coal and oil and gas are likely to continue to produce losses. Equities, either developed market or emerging market, are not going to be strong, positive support and returns unless they are sustainably themed. And you can see that the all world equities sustainably themed do quite well to 2050 in the most optimistic scenarios. There's no evidence in CPP's public reporting that their equity holdings, either globally in the emerging markets or in Canada, are sustainably themed. So we suspect that they will continue to show losses. So that's the second concern. Next slide, please. The third concern, continuing in the theme of we don't know really what they're doing, at least close to a quarter, 24.7% of CPP's funds are in private equity investments. Either direct ownership investments, and I'm going to talk about 2 in a moment, or as partners with other investors in private equity firms. CPP has a list on its website that it updates regularly of what private equity firms it is an investor in and what its financial commitments are, but we have no idea what those private equity firms are investing in. What companies are they buying and restructuring? So again, a real lack of transparency, even though there is a lot of information that is produced. Their latest annual report is 185 pages long. Of more concern is this particular division, the Energy and Resources Division, which was established to establish companies, to put CPP employees on the board of the companies being established, and to continue to expand, presumably. And these companies are involved, all of them, in oil and gas exploration and production. So I'd like to talk about 2 examples. One is in hydraulic fracturing in the US, and the other is in the oil sands support in Canada. You can see that this division is growing rapidly. This is right now, its assets under management are $7.3 billion, but it has, so far as we know, put in at least $10 billion. The reason that its assets under management now are $7.3 billion is because it lost 23.4% on its holdings in this division in the fiscal year 2020. Next slide, please. So what are the concerns? CPP emphasizes in every one of its private transactions and in every one of its annual reports that it has a long-term perspective and it is patient capital. But so far as we can see, at least in this division, it is using those substantial resources to support hydraulic fracturing in the US, which is normally called or abbreviated fracking, and oil sands development in Canada. Particularly oil sands development is problematic because market investors are withdrawing or reducing their investments. So let's talk about two examples, one in each jurisdiction. In Colorado, the next slide, please. Thank you very much. CPP established this company, Crestone Peak Resources, which engages in fracking. There are three problems with the Crestone investment. One is that it is continuing to invest in fracking. Second is the political influence that Crestone engaged in the 2018 elections in Colorado. And third are conflict of interest concerns. I see I only have 2 minutes left, so let me just say about Crestone. It was a purchase from Encana when Encana was scrambling to divest itself of its not highest quality assets. At the time Crestone was established, 95% of the shares are owned by CPP. At the time Crestone was established, there was a ban in place on fracking in many of the areas where Crestone's new purchases, fracking assets are located. And there was challenge to fracking bans going up to the Colorado Supreme Court. We have evidence that $607,000 of Crestone resources were put into the elections in Colorado in 2018. Half of it in the pro-industry group trying to and successfully resisting a proposition that would have reduced fracking close to schools and houses, and half of the money was put in to support Republican candidates for the legislature. At the time these contributions were made, either 3 or 4 of the members of the board of directors, 7-member board, were CPP employees or former top executives. So there are conflict of interest concerns as well as the political influence concerns. Next slide, please. Wolf Midstream is a company that CPP established and holds, again, substantially over 90% of the shares. It is a company that has bought the access pipelines in Alberta. And it has also put some amount of money into the carbon trunk line, which collects carbon from industrial facilities and uses it to upload mature oil fields, extract a little more oil, but also to put the carbon into the ground. This is a concern both because your CPP is supporting the oil sands development, but also the CEO of CPP has used its $300 million investment in the carbon business to suggest that CPP is actually serious about climate change, whereas we don't hear about the $2.3 billion investment that allows this oil pipeline to grow and stay stable through challenging times in the oil sands. Last slide, please. The most serious concern is the lost opportunity for Canada, right? $63 billion going into Canada is a tremendous amount of support that could be going into establishing companies to develop new products, engage in research and development, figure out ways to monetize conservation services, retrain workers, make the Task Force for a Resilient Recovery and the Build Back Better plans reality. CPP has an important role to play in Canada, securing pensions, of course, but also securing the future that we need. Thank you very much.
Thank you, Professor Williams, for that detailed overview. It certainly highlights some inconsistencies with CPP's investment strategy if the fund is hoping to support the type of jobs and infrastructure necessary to secure Canada's future. So turning now to Nick, Mr. Nick Silver, you are Managing Director with Calland Consulting, an advisor to public sector pension funds around the world, and you've worked with resource-intensive countries undergoing similar transitions. What are your recommendations, Nick, for CPP investments in light of Professor Williams' report?
Okay, well, hi, thank you very much, Javara, for having me here. And can everyone see me on my video? Is that, am I, okay, great. Yes, well, thank you very much for inviting me here. I have great love of Canada. I've been there a few times and I'm glad to visit Canada from my house in North London for the afternoon. And thank you, Cynthia, for that really great report and talk. So in the questions and answers, there was a question from Ronald Davis, which is very useful because my talk is an answer to that question. Very good question, which was, if you cut off investment to oil and gas, CPP's contribution will be diminished due to the subsequent unemployment in the industry, kind of, won't it? So basically my talk's an answer to this question. So that was very good that you did that. To sort of summarize what Cynthia has said, I think the critiques of the CPP are that it's overweight in oil and gas, especially in Canada, that there's a kind of lack of transparency. So a lot of the large chunk of the investments in Canada, you can't really tell if they are in oil and gas. Just individual cases like Crestone Peak Energy and the Energy and Resource Group. And these sort of imply that although the CPP sort of talks the talk, it doesn't seem to have an overall climate strategy. Right? So I want to now go back a little bit just to describe, just go back through my career actually, and to kind of explain, to give a sort of different perspective on CPP and why actually it's kind of should be taking climate a lot more seriously than I feel it is, and purely not from any ethical reasons, but purely for risk financial reasons. So I started out my career as a normal actuary, advising occupational pension schemes in the UK. And an occupational pension scheme is a trust. So you have a company which puts money aside for its beneficiaries, its pensioners. Each individual scheme, though they can be quite large, are very small compared to the economy. So the duty of the pension scheme is to its beneficiaries, the pensioners, and that's very skewed to the older people because they've built up a bigger pension. It has to be a self-contained entity, so if the company that sponsors it goes bust, the pension can continue. Then you come up with a concept of fiduciary duty, where the duty of the trustees who run the fund is to the pensioners, and they have to invest the assets to maximize their return, but minimize their risk. And the fiduciary duty and the ESG framework has grown up in respect to these types of schemes. And so ESG and things like climate are considered non-financial risks. They are things that the scheme, because they're quite long-term investors, should consider. And there's also often an ethical dimension. For example, churches' pension funds have been really big in ethical investments. And the sort of typical time frame is sort of 20, 30 years when your pensioners got to start retiring and taking their money. And even in this scenario, ESG has become mainstream. Lots of investors say most big investment houses say they've internalized ESG factors, and there's a huge amount of money going into ESG. But the Canadian pension plan, a national pension plan, is quite different. It might be called a pension, but it's essentially a different entity, and you can't use the framework when you're thinking about a private scheme for for the Canadian Pension Fund. And what the difference are, basically you have contributors paying in, and they are mandatory contributions, and they pay in to pay people's pensions. And then you have this assets which is big. I mean, it's in the Canadian Pension Fund, about $400 billion, but it's effectively a buffer fund. It's to smooth the contributions which are paying the pension fee to build up this fund over here. And the Canadian pension plans, the way it's valued or looked at, it has to be sustainable over the long term. Note the word sustainable. And the way it's done is on a steady state basis. So the buffer fund is sort of constant in relation to the size, and additional benefits are fully funded. The 30th actuarial report, which I just read, has to show that the fund is sustainable over 75 years. It has 75-year projections. Now, if you think 75 years takes us to 2095, time when, if we think about climate change, the world will probably be 3 or 4 degrees warmer, and the Arctic region, of which Canada is part of, might be 6 to 8 degrees warmer. Right? Just have that in your in your mind. And the other difference is the Canadian pension plan is very big compared to the size of the Canadian economy. So I mentioned $400 billion compared to an economy of $2 trillion. But if you actually think about the plan, it's much bigger in size, because most of its value is in these contributions. You know, if you actually calculated these actuarially, it will be many times the size. It will be sort of at least as big as the Canadian economy, and so its decisions make a big difference to the Canadian economy, unlike an individual occupational pension plan. So this means that when, unlike an occupational scheme, which has a duty to its pensioners effectively, the Canadian pension plan, its main assets, its main duty are the contributors, the people who are young now, who are still contributing. They have to be able, you're assuming that the Canadian economy, which is going to survive in a 3 to 4 degree warmer world, or maybe even a 6 to 8 degree warmer world, is going to continue to generate income, employment to people who are going to pay the pension. So when I do actuarial reports of country level schemes, I actually put, well, my company puts right at the front that climate change is a major risk to the sustainability of the fund, because we got to think over 75 years. And my interpretation of the actuarial guidance is, I feel for myself that I'd be professionally negligent if I didn't put this as a risk, given the time frame of the scheme. And the British Institute and Faculty of Actuaries actually 2 years ago sent a warning to all their members of climate change being a risk. So, you know, I've been warned, and this is what I take into account. So why is it a risk? Well, obviously there's this physical risk over the longer term, and given Canada's geography, there'll be a risk. Canada is very heavily heavily dependent on resource extraction. I find this number hard to believe, but in Cynthia's report, so that 17% of Canadian GDP is linked to directly or indirectly to resource extraction, including oil and gas. You know, just as someone who reads the Financial Times, not as a professional investor, but you've had a spate of reports coming out, like DNV, saying that oil and gas use has peaked already. It peaked last year in 2019, according to them. BP have said it may have peaked now, or maybe in the new picture. The Energy Transition Commission says that the internal combustion engine is a stranded asset. And if you read, like, the FT, Financial Times, so British equivalent of the Wall Street Journal, yesterday had an editorial saying that about the reporting on the slow death of big oil. So I would say these scream to me big like risks. And if you think of the Canadian pension fund's assets as being its future contributors, who are very heavily dependent on oil and gas, any investment by the CPP in the oil and gas sector, is doubling down on its risk. It's not only saying, we're actually at risk, the Canadian economy, which we depend on, is at risk, but we're actually doubling up this risk by investing in oil and gas. And if you look at equivalent countries like Norway, for example, the Norwegian pension plan has divested from oil and gas, not for ethical reasons, purely for a financial risk perspective, because not climate change is one of the drivers, but it's more that Canada is heavily dependent at the moment on an oil industry, and it's expensive oil, it's tar sands, it's not cheap oil from Saudi Arabia, and this is going to be the first that's hit by the decline in oil. So as Cynthia was mentioning, the Canadian pension plan, because it has this long time horizon, it's dependent on the Canadian economy. It has a much stronger fiduciary duty to actually get involved in the Canada's transition out of fossil fuels, purely because it's a risk to the long-term sustainability of the Canadian pension plan. So if you look at the mission statements of the CPP, as in Cynthia's report, it says, it actually looks like they're talking the talk, but they're not really walking the walk. They actually, because this is such a substantial core risk to the Canadian economy, it actually needs a strategic plan of how we're going to transition out of fossil fuels into renewables. And I think I've got to wrap up. So just going back to Ronald Davis's question. So yes, the CPP does need to do stuff so that people will be employed and contributors, but the fact that Canadian employment and the economy is over dependent on fossil fuels, it's got to ensure that these people have jobs and an economy as the world transitions out of fossil fuels. And so because of its large size and magnitude of its investments, it actually needs to actively encourage this transition. It's sort of very much in line with Cynthia's report. So I hope that's been helpful, and I think I've said as much as I can for the time being, and I'm delighted to take questions later. Over to you, Joanne.
Brilliant. Thank you, Nick. I think your comments are a sobering reminder that Canada is not an island. We are connected to this shift happening all over the world, not least through capital markets. And as Canadians, we need to stay ahead of these changes if we're not to be left behind. Now, I would like to turn to Mr. Simon Archer. You're a lawyer and partner with Goldblatt Partners and a pension fund advisor also. So Simon, bringing this back to the law, can you relate Professor Williams' remarks to what you are seeing happening in the growing field of climate law?
Yes, I can. Thank you very much, Tavara. I think in reaction and response to the report, very interesting report and a timely one, I could make sort of two sets of observations about it. One, situate it within climate litigation that we're seeing today generally, and then to talk a little bit about, and Nick touched on some of these things quite helpfully, the legal frameworks for pension fund investment decision making. And of course, that's a couple of those decisions, or several of those decisions, are really drawn out and highlighted in the report and some of their implications. So just starting with the first, Professor Williams' report comes at an interesting time. Climate change litigation, and we now call it climate litigation or climate change litigation, is developing very rapidly. And the most immediate local example is next Tuesday and Wednesday, the Supreme Court is going to hear the reference on the Greenhouse Gas Pollution Pricing Act, which, as I'm sure everyone on the webinar knows, is seeking to set a minimum standard price on carbon across the country. And all of that's in aid of meeting the Paris targets of 30% below 2005 levels by 2030. And they've hinted recently that maybe they're going to try and make the new targets net zero by 2050, which are common and around the world. But the reason it's of note is because the fact that we're at the Supreme Court with three major provinces challenging the application of the Act and the constitutionality of the Act is an indicator of the attitude towards climate policy within which investors operate that we have in Canada. And Nick has sort of said this in a couple of different ways. We have an economy heavily reliant on fossil fuels. And so it's perhaps understandable that at different levels of government, different actors within that economy have had a slow response in some ways to the urgent action that's required to address climate change. Climate denialism is a phrase that gets tossed around. And so this report, first of all, falls into a context of some form of climate denialism in Canada, by different levels of government, by different actors, and within a rapidly changing, as I've said, field of climate law. There's textbooks now, there's treatises, so when you get to that level, it's a thing and it's out there and it's developing. And I think for the purposes of responding to the report, it helps to situate it within 2 or 3 major categories of what we see as legal actions. Pardon me, I'll turn that off. Legal actions relating to climate change around the world. And the first set of cases we talk about often are cases brought against governments, asking them or forcing them, seeking to force them to adopt more stringent policy goals. And the most famous one you all know is the Urgenda case out of the Netherlands, which was successful. And we've had derivative or similar kinds of cases in Canada, the Jeunesse claim out of Quebec, and there are other ones copied across the country and in the United States now. And very interestingly and of relevance, one of the core elements of those claims seeking to force governments to adopt stricter climate policies is an intergenerational argument. And this is one of the aspects of Professor Williams' report that gets drawn out when you read it. The second broad category of cases we see are cases brought against corporations, but in particular the carbon majors, as they're called. And so, for instance, we've seen a swath of US municipalities and other levels of government bringing claims in public nuisance generally against some group of defendants of the carbon majors, seeking essentially damages for the costs of mitigation, which every year are becoming better understood, better recorded, better measured, and of course, bigger and bigger. And the model for this litigation, this sort of liability, is the tobacco litigation, and it's often compared to it. And the end of that tobacco litigation is an interesting goal to talk about. There was statutory reform, and of course, the cases were eventually very successful. The third category that we often see of advocacy, I'll call it, I think it's going to lead to litigation eventually. We haven't seen as many cases yet, but we can talk about one, is claims brought against investors, and particularly institutional investors. And the purpose of these claims is to cajole these investors into transitioning away from carbon-based assets and towards alternatives, renewables, and green investments. And that's very much what this report is, I think, intending to challenge Canada's largest institutional investor to do. But just in terms of litigation, most recently and of interest to compare on the heels of this report is the McVeigh versus Rest, the retail super in Australia, which I think is going to court at the end of this year, November, December. And we'll be watching it to see what they're going to say. It started as an information-seeking exercises and ended up as a breach of fiduciary duty exercise along the lines of what we're thinking about when we read this report. But in other advocacy modes, we've seen the divestment movement, carbon divestment movement, a loose term that needs defining, but it's popped up on campuses stronger than ever, and some have made positive mandates to divest. UBC, and there's an active one at University of Toronto right now, and so pension plans, but particularly in the public sector, university sectors, are being lobbied to try and adopt mandates along the lines that we see urged by Professor Williams' report here. And unions actually are often at the forefront of this kind of advocacy, trying to ensure that their plans stay out of the stuff that's dangerous and get into the stuff that we think is going to be the future. And that divestment movement actually falls within a larger sort of very rapidly developing trend now. And again, Nick adverted to this just now, and that's the rise in ESG factor investing, environmental, social, and governance factors. They're all understood unevenly and in different ways and in different places, but it's really exploded in the past 5, maybe 10 years. And really, I think the one takeaway from that growth, and there's lots to talk about within it. There's some very active and divisive debates in the States right now, but one of the takeaways is that the advisory community has developed the tools to do it. So it's no longer really a robust excuse in any way to say, well, there's nothing there to buy, or there's no way to do it easily, or something like that. That falls in a particular way in Canada. because of the shape of our economy and the reliance on fossil fuels and the degree to which the financial sector itself is imbricated in financing fossil fuels. But there are tools out there. There are managers that can do it. There are ways to transition out. So the growth in ESG investing opportunities, advisory functions, and so forth over the past few years has really made it more possible than ever, not just for CPP-IB, which is a large fund and has some very special features, which I'll turn to next, which we have to think about when we think about the legal frameworks, but for any large institutional investor or any pension fund fiduciary generally. So the question comes then, if we have the tools and it can be done and we think it ought to be done or beneficiaries want it to be done, do we have to do it? Are we legally obligated to do it? Or are there constraints on us doing it? And this has been one of the sort of battlegrounds of the past 30 or 40 years, is the term fiduciary duty that that Nick drew out, and that's part of the statute that governs the mandate of the board in making its decisions. And it's been a little bit of a battleground, and perhaps to the chagrin, if not maybe even the shame of my profession, the answer has not always been a clear, yes, you should be taking these factors into account. Yes, you should be transitioning out of carbon-based assets. And there are reasons why, but they're increasingly not good reasons. And so I'll just speak to this problematic very briefly, because it could be another 2 or 3 hours or days on its own to try and unpack it. But in the final section of Professor Williams' report, she adverts to a number of the kind of main threads of this discussion, and it's a fascinating discussion that I think we need to develop further. But just starting from the point of what is in the statute and what is the duty, the board has a duty to invest its funds in the best interests of the beneficiaries, which is articulated, and it says this in the statute, as the best financial interests, or in other words, the best risk-adjusted rate of return. And that's a very standard expression of the duty on pension fund fiduciaries in making investment decisions, and it's got a long history. We won't go into that history. It's a very interesting one, and it actually, despite the primacy of the risk-return factor consideration, it actually admits of a very wide variety of investment behaviors. It's what we call an open textured norm, in which a decision maker has to take into account, all material factors in that analysis, but what those factors are and what the development of the science underlying and informing those factors are can change very rapidly. And so the test won't change, but the underlying result in applying it will change over time. And we're in one of these moments where it really does have to change, because as we've just said, the ESG advisors and the climate science and the materiality of the risk that Nick did a good job of outlining very briefly in 5 minutes is all now much better understood. It's credible, it's available, it's sophisticated, and there's an obligation to take them into account. So the answer should be yes, you should be doing this. And then it's, so how are you doing it? And in Canada, for perhaps reasons that we've talked about, the climate of denialism, if I can call it that, it's sometimes been slow, a very slow pace sometimes, and this is really part of the incrementalism that the title of the report speaks to, the uncomfortable incrementalism that we have. And reading Cindy's report, it really brings it forward to you. An incrementalist approach to this kind of change is no longer adequate to the policy problem underlying it. And I realize that I'm skipping from an investment decision to a wider policy framework there, but I'm going to try to situate them together for you in the final couple minutes of my remarks here. So not only is this sort of incrementalism not adequate to the task of addressing climate-related risks, and Nick made not even an ethical concern or a climate-based concern, but just a risk concern to the portfolio argument for this. It requires stronger government actions, as one set of cases say. It requires corporate action, as another set of cases are focused on, but it also requires investor action. And we have to highlight the inadequacy of an incrementalist approach, I think, and that's what this report does. And I'll try and unpack what kind of investor action, what the effects of that might be, and why that might link back into the legal framework and the fiduciary duty that we've been talking about, that is the duty of the board to take to implement. Let me just skip ahead here, because I'm realizing I'm just a bit out of time. the report suggests, and Nick really emphasized this, that the best interest tests that's in the statute has to be interpreted in light of the structure of the CPP-IB itself, the very large pension fund fiduciary, and also the structure of the plan, which is actually unique to the CPP-IB. It's a buffer fund within a larger pay-go plan, and that really has to be the matrix in which investment decisions have to be understood. And there's been some discussion about the position of very large institutional investors in the market, the so-called whole economy investors that have massively diversified portfolios across all sectors of the economy, not just domestically, but internationally as well. And the suggestion is that the fact of this size and these portfolios mean that they have a different type of duty and a different analysis when you analyze what standards should they be held to account when they're making investment decisions. So Professor Williams' report footnotes a couple of these strands of literature. One local author, two local authors, Ed Waitzer and Doug Sarrow, have called these investors public fiduciaries in a couple of papers from 5 or 10 years ago, in which they describe the kind of connections that are there, the kind of role that the large investors have on the economy, one of which is whatever their investment decisions are going to be standard defining in a smaller economy. They're so large in relation to the economy as a whole, or into the investment universe as a whole, that whatever they do is going to send a lot of signals to the economy. So coming out of fossil fuels and going into renewables is an important effect of their behaviors that should be taken into account when we try and define a legal standard by which they should be judged. And there's debate within this, of course. This is, in some ways, it's still what I want to call an academic discourse, because it hasn't been tested in courts, but it's a very interesting one that needs to be pursued. In the United States, a Harvard academic has called this the problem of 12, the 12 very large institutional investors or intermediaries and institutional investors. A Bloomberg columnist is calling the debate over ESG factors a debate between substitute governments. To what degree should large institutional investors be, in a sense, setting climate policy, if we can put it very pointedly, by making these kinds of decisions? So there are debates about it, but it is pointing to an important effect of their actions in the market. And so it leads us to one of these reflections. These large public investors are at pains, for very good reasons, to be seen to be making arm's length decisions from their political sponsors. And those are all very good reasons, and yet they always exist within the politics, the climate policy, and the other aspects of government policy that surround them. The CPP is a very interesting example. It exists by virtue of all the provinces and the federal government working together voluntarily to make this plan work. But all of them have different ideas about appropriate environmental policy and where resources should be allocated. And so it has to pick its decisions within that framework. I mean, that's why we're at the Supreme Court next week, because of those differences. But this also highlights the importance of the CPP's actions as an investor in doing this. So while large pension funds themselves, other than CPP, may have a whole economy or a public fiduciary aspect, and this should inform the way in which we understand what their risk-return analysis should look like. The CPP-IB itself has a unique aspect to it, and that is that a large part of its revenues are derived from, as Nick has just said better than I have, from the Canadian economy as a whole, and that has to be part of the understanding. Why don't I wrap it up right there? I see I'm out of time. Thank you.
Thanks so much, Simon, for that. I think that's a very important key takeaway there, is that now that climate change is a material financial risk, legal standards are shifting, and fiduciary obligations will have to keep up as well. So I think that's it for our commentary right now. We do have some time for questions, and I'd like to take one right off the bat. So Simon and Nick, if you'd like to turn your video on. There is one question right off the bat that I'd like to put to Cynthia, and also Nick wants to answer this one, but spokesperson for CPP did make a statement about our report. And while it acknowledged that the energy sector has, well, the strongest motives and access to capital to adapt, but they say, they contend that divestment or starving them of capital would be harmful and counterproductive. So I think it'd be great to kick off the questions, and probably have time for 2 or 3. But let's start with that one. And Cynthia, as the author of the report, I'd like you to have a chance to go first, and then Nick will go with you next.
I would like to hear Nick's response to that, actually.
Okay. Oh, thank you. I don't. Do you have the expression in Canada, hospital pass? But that's
What?
A hospital pass. It's when someone passes you the ball, and then you get job when you don't want it. This is. There are two strategies. So I mean, we haven't really gone into what the Canadian Pension Plan should do, but I mean, in the ESG sort of field, there's engagement, which is you own the companies, you own oil and gas companies. CPP, I assume, has pretty high holding in any given large Canadian oil and gas company, and so quite a lot of influence. And then you can engage the company, which is you talk to the senior management and you vote at AGMs. And if you look at like a lot of the leading oil and gas companies like British Petroleum and Total, I think they're switching out of being oil and gas companies. They're trying to reduce their oil and gas exposure. Now, I haven't studied this in detail, but I pretty guess and bet money that the Canadian Pension Plan hasn't engaged with its oil and gas holdings in Canada to say to them, look, you should be reducing your exposure to oil and gas and building up your fossil fuel business. Well, first thing. And then the second thing on the other option of disinvestment, well, in a lot of reports from a British NGO called Carbon Tracker have pointed out that the oil and gas sector are continuing their using capital to continue exploration and development of new oil and gas assets, and there's no room for, within the Canadian government's policy, climate change policy, the global Canadian government, the global and the actual facts on the ground, like that people are using less oil, for Canada to develop more and more, tar sands type oil and gas. So any capital that's invested and then used for research and development of new oil and gas is dead capital. It's losing it. So it's like saying, this is giving away money which is about to be destroyed. So I don't really buy that argument. And even if you take that argument on its third, we would be starving these poor oil and gas companies of capital. Well, no, actually, you don't make up such a large portion of you'll be sending a signal that they're not in line with our long-term policy goals, and which is correct. But what's the actual, what would be the direct implication of the CPP, for divesting if it did?
Thank you, Nick. And Cynthia, did you want any follow-up comments on that one? I've got a couple more questions that we've got about 8 minutes to cover.
Yeah, I mean, I think I would like to just reiterate that this notion of starving them, starving the energy resources from their capital almost implies that CPP thinks it has an obligation to keep them stable during this transition. And I don't understand that. I mean, it's as a financial matter, it's very risky, as we've been discussing, but it's also inconsistent with the Canadian government's long-term policy goals. And so as the policies get implemented, it becomes even more of a financial risk. So we still challenge them to think creatively about what role they could play in the transition.
Yeah, I think this is an important distinction, or kind of highlights that it's almost like we're talking about two Canadas, and people are using some data, like Nick, you referenced, I think the GDP being very tied up with resources, but there was a lot of chat about that and contending that actually, renewables employ 300,000 Canadians. That's expected to grow 4 times as fast as the rest of the economy, while in the oil and gas sector, we are expected to see declines. And this is even pre-COVID and pre the price crash of oil. So I think that's what we're talking about. And I think it's important how we can use this information to try and unite us in our efforts to make Canada stronger, because there's themes on both sides in terms of investing in technology and investing in the future. I think it's just a question of how exactly we're going to do that. So the second thread of questions is really saying, if fiduciary duty is changing day by day in response to the climate crisis. And CPP investments might no longer be meeting its statutory obligations. What are the next steps? And others have very specifically asked whether the CPP-IB Act needs to change to increase transparency or require the board to play an actual role, a stronger role in ensuring Canada meets its climate commitments. So I think Simon definitely could part of that question, and Cynthia, you should have some final comments as well.
Sure, let me take a quick stab at it. They're a good suite of questions, and I think just addressing what I'll call the denialism or maybe the conservatism in the way in which our institutional investors have sometimes grappled, not all of them, but sometimes grappled with climate change risks. Yeah, I think that absolutely it would be helpful, and that's a very good suggestion, if the statute were amended to include an express requirement to address them and not to let an interpretation of the existing and very standard language, which, like I said, is open-ended, can be filled with a lot of different meanings, not to let that stand in the way or be an excuse for not doing this. And it may help protect, I guess, the decision makers, because it would be a statutory requirement to do. They couldn't ignore it, and it's not them making a decision to ignore something or anything like that. So that's absolutely a valuable suggestion. And if you'll recall back to the divestment movements, and this is a long time ago, so not all of you will, but the anti-apartheid divestment movements in the late 1980s and early 1990s. And in the end, in order to get some of the similar actions we wanted from institutional investors then, we had to create statutory protection for making those divestment decisions. So it makes sense in a certain way that would be a useful thing to do. But then what to do generally, I mean, it kind of depends who you are. But I think that CPP-IB, and to some extent, large public pension funds anywhere, one of the, it's not so much a vulnerability, but one of the weaknesses that is there that the report highlights, and that I think assists everyone in achieving the desired outcomes, is greater transparency. So greater sunlight on the problem. What's in your portfolio and why? And I think the McVeigh case that I mentioned very quickly earlier is a kind of an example of how activism will unfold that way. Advocacy will unfold that way. You're just asking what's in the portfolio. We'd like to come to a judgment separate from yours about whether what you're doing to mitigate climate risks and protect the assets and the beneficiaries, whoever they are, is adequate. And it's been very difficult over time. Some of the standard reasons that are brought out to oppose greater disclosure are things like, well, this gives us market risk, or there's some sense in which we're going to be at a disadvantage by disclosing our portfolio even, or our strategy around it. And I think that just doesn't hold water as much anymore. Typically when you're getting portfolio disclosures, they're around a year old anyway. You've already bought it. And so the market risks are a little bit different. Now, of course, you don't signal what you're going to buy so that you pay too much for it when you're going out, but you can still have a policy discussion that's more detailed than what we have. And Nick adverted to it. It sounds very good, but it also feels hortatory because there's other things that seem inconsistent with it going on underneath. And we have to close that gap, I think, so that you can be seen to be doing. And there are other pension funds that are doing it, European ones mainly. And Nick maybe can speak to a couple of the ones and what they do, but a couple of the big Dutch funds and Norway, as Nick said, have really embraced foregrounding their strategy and letting people know more accurately what's going on. I don't know if the Dutch response is because they had more successful. The agenda claim is one of the things, and some of the financial sector folks have gotten together and responded more positively to the OECD touch point, for example. But so there may be other reasons, and Nick might want to supplement what I said here with some, or contradict me.
We have 2 minutes left, so I would like to have one final question, but Cynthia, if you wanted to comment quickly on that one.
Yes, I would just like to say that Quebec has shown leadership in this regard, right? They've made very clear commitments for increasing their funding in low carbon investments, and they've made their commitments public, and they've reported on how they're doing, and they've also made very clear commitments for reducing the carbon intensity of their portfolio and eventually getting to net zero. So we have close at hand some good models.
We do. So we're going to wrap up few small comments from people. I'm going to ask everyone to look into their crystal ball. So I like to say change happens slowly, then fast. I don't think I coined the term, but for instance, Sweden, when they were discussing changing which side of the road they were going to drive on, they discussed it for, I think, a decade or 2 decades or more. And then when they did it, they flipped the switch, they pulled off the Band-Aid, and they just did it overnight. So disclosure standards we feel are coming, clarification of fiduciary duty is needed, and a few of the questions are asking when. So very quick, crystal ball, when is this going to be clarified?
I think it depends on whether CPP takes this report seriously and responds as a public relations exercise, or whether it really tries to think carefully about some of the comments, both in the report and also that Nick and Simon have brought forward. So that's my dodge.
I'm happy to make a very quick comment. The best climate science tells us that it has to happen this decade, within 10 years. So the transition and the explanation of it have to happen now. I mean, that's the science.
Okay, can I answer a slightly different question, being like my attempt at being a politician? Was the previous question about what needs to change, and I don't think it's actually regulation. I think it's culture. So what you tend to get is you get the something like CPP, big importance. So you give it to experts, actuaries like myself, or investment managers, and the ones in Canada are schooled in the wrong school. Like they're schooled in the Anglo-Saxon school where market knows best, etc. The Norwegians and Dutch and Swedes are schooled in. They were never brought into that, and so they are much more open to, you know, the sort of stakeholder capitalism model, and actually. It needs the people in charge to actually change their worldview. So and when that happens, they can see, this is the point of my existence, and the point of where I'm investing is not what I thought it was. They'll do that, but I will be a bit skeptical of that happening, because I think that it's very hard to get over your own sort of schooling and bias, and therefore probably things like deliberative democracy, where you have groups of people questioning stuff from other perspectives, and that changes people's minds. So it's more when it could happen then immediately, but I doubt it.
Thank you, Nick. Thank you, Simon. Thank you, Professor Williams, for everybody's comments. I think we started to open up into new fields of discussion there, which we hope we can continue with our audience. Thank you for joining us all from wherever you were today. And we posted a link to Professor Williams' report again in the notes. It's at the beginning and at the end there. Please do get in touch with us at Canada Climate Law Initiative, and I wish you all the best for today. Thank you.